Hello and welcome back to the channel. This is now part 3 of my small lecture on economic backgrounds of taxation. And today we are going to talk about, to be honest, I am going to talk about, you will either listen or not. But today's topic is income tax, and let's begin with a small overview. As you know, a good structure always, or every structure, even a bad one, should always have some underlying logic. And so to explain how we are going to arrange the contents, just let's look to what defines a tax. The defining elements of a tax are, you know that by definition, the tax base multiplied with the tax rate. And so that is where we are going to look on. Now, the tax with the highest importance for enterprises and investors is usually the tax on income. That is why we talk about this just now. And to make that clear, taxes on income is usually the denomination for the income tax, which is mostly levied only from natural persons. So from physical persons, individuals, or however you call them. So these persons who exist in nature, in a vulgar way called human beings. And there's also the corporation tax or corporate income tax, which is then levied on the income of juridical persons or legal persons. So persons who only exist under the perspective of the law, fiction of the law, like a GmbH, an AG, a stock corporation, things like that. However, there might be sometimes and in some states some additional taxes on special sources of income. For example, there would be, or even worse, there is in Germany a trade tax levied by the cities, which is only levied on income from business as an additional tax. So let's go back to our basis for our structure. So the trivial formula for every tax burden is tax base multiplied with the tax rate is defined as the tax. So if we want to look at the taxation of income in more detail, it seems to be a logical idea to look at tax rates and tax base and how they are defined. We are going to discuss the tax rates and their effect first, and then the tax base, because then we have logically covered everything. And so that is what will be our short topic today. Yeah, okay, so let's first ask which questions might be potentially interesting with regard to tax rates and their effects. Well, the first and very simple question is how much money remains net after tax? That's necessary because you need to know how much money you can spend for your private consume. And if you spend more than this net income, you will have, you will have a lack of money when it comes to paying the tax. So you probably will face bankruptcy. However, if you are already relatively rich, probably you don't intend and you will no longer be able to spend all your money and your income for private consume, but then it will still be interesting to find out how much money you will be able to reinvest. Because if you reinvest more than your net profits, then again, you lack the sufficient and necessary money to pay your taxes at the end of the year or through the year. So again, financial problems up to bankruptcy might be your consequence. The second alternative would be to ask how much gross income do I need to produce if I want to have a certain amount of net income available for consume or reinvestment. So that's the same question, just the other way around, and very often it's even more interesting. So the mathematical background for solving these questions is more than simple. Net income is gross income multiplied by 100% minus S, and S here stands for the tax rate. Now, this equation, simple as it is, also gives us the approach to solve the second question, because if net income is gross income times 1 minus S, we automatically have that gross income times 1 minus S is net income, and that gross income then can be expressed as net income divided by 1 minus S. So simple, more than simple. Having established these two little formulas, we can think about consequences of tax legislation a bit. For example, how high is the net income of a taxpayer if the income tax rate is 40%? Well, that's more than simple, 60 remain. However, not every tax computation will end up as simple as that sounds here. We will come to that later. How much income must the taxpayer generate? That sounds a bit more interesting. In order to achieve a net income of 100 if his or her income tax rate is 40%. The answer is gross income is net income. Let's say here 100 taken times 1 divided by 1 minus S. So here 100 net income divided by 0.60, and that leads us to necessary gross income of 166.67. So you already have to generate relatively high gross income to end up with your desired net income. However, all these calculations become far more interesting if we fill it with some more concrete knowledge about the existing tax systems and tax rates. And so for this purpose, we should first inform ourselves a bit more in a detailed way about the existing tax rules. For example, what you should remember or should know if you have not got the information before is that income tax nowadays is usually progressive. The underlying idea is that the tax rate is never the same for every taxpayer, but the rich are expected to pay a rich percentage, so a high percentage of their income, and the poor are expected to pay only a poor percentage, so a small tax, and the taxpayers in the middle are expected to pay a medium tax percentage, so in between. That's the idea of progression. The underlying idea is that if, let's say, somebody has 10,000 euro only and needs 9,000 to survive, then taking 10% of the income of this taxpayer would be 1,000. So you reduce that person's wealth from 10,000 to 9,000. So that would be a drastic change of that person's everyday life, because 9,000 is the pure, or might be the pure survival amount. 10,000, that would be including that this person now can afford a simple Christmas present for friends, can afford to have 1 or 2 cinema visits without popcorn probably at that price level, and some other things. Now with 10% tax rate applied to this person, all that very, very basic luxury is gone away and destroyed. If you apply, on the other hand, a tax rate of 10% to a billionaire, there will be no impact on that person's everyday life. And even more if you take 50%. If you take 50% from the billionaire, there is no impact at all on the everyday life of that person. Because if you want to buy a house, you still can buy it. If you want to buy a yacht, you still can buy it. It doesn't matter if each day you have 1 million net or only 800,000 net. Okay, that's an extreme example. We all dream of ending up this way. It's not realistic, but it shows that indeed a high tax rate here doesn't touch your everyday life if you are rich enough. On the other hand, imagine our 10,000 euro guy now faced with a rate of 50%. That would be probably a complete financial breakdown here. That person would probably not survive the year if he or she had to pay that tax. So that shows that for people with a small income, the impact even of a slow or low tax rate can be far higher than of a high percentage on a rich, and that's the inner justification why nowadays tax rates are progressive. So in a progressive tax system, we will find situations like the following. Taxpayer A has an income of only 20,000 and pays 10%, that's 2,000 as income tax, whereas taxpayer B has an income of 200,000 and pays 20%, that's 40,000 as income tax. So the rate goes up. Please note that not every tax where rich people pay more income tax than poor ones is automatically a progressive tax already, because the income tax could be 20% for everybody. This would then be called a proportional tax rate or a flat rate tax. In such a case, a rich person with an income of 500,000 euro would pay a tax of 100,000. A poor person with an income of 20,000 only would pay a tax of only 4,000. So the rich pays definitively more than the poor in such a system, but it's not progressive because the percentage of the tax here stays the same. And this is the reason why this tax is not yet progressive. Progressive requires that not only the tax burden, but also the percentage of the tax, so the tax rate goes up with increasing income, at least until an upper limit. Okay. So, however, when you design such a progressive tax system, there are certain inbuilt limits, what you can do and what you can't do. The first basic rule for every progressive tax system is that it must never, under no circumstances, happen that a higher gross income leads to a lower total net income of your taxpayer than before, because if you do it otherwise, creating a higher income might make people poorer than before. And so the natural consequence for these people would be to avoid working more, to avoid having a higher income, and to avoid getting richer. So the total incomes of your population would stay lower than possible. Consequently, the amount of income taxes paid by your people would be lower than possible. And consequence of this would be, as a state would by such a system damage its own interest. So that must be avoided under all circumstances. Would be detrimental to both involved parties. However, how can you ensure that your tax system doesn't provoke this effect? Increasing tax rate leads to lower net income, although gross income was increased. Well, you can make sure this in a very simple way. You must only design your tax tariff, that's the list of your tax rates, in a way that whenever the tax rates become higher, this only applies to the next part of the income, whereas the first part of the income keep their lower rates, so only the marginal rates increase for the additional euros, and there is not a retroactive increase of the tax rates for the existing first part of the income. So if an income of 20,000 is taxed at 10%, everybody keeps this 10% for the first 20,000 under all circumstances, and only when you or if you achieve higher income, then only the parts of the income which are higher than 20,000 will be taxed under the higher rate of, let's say, 20%. Now, this sounds perhaps a bit abstract, so let's talk about how we as a legislator, following these principles, would have to design a progressive income tax tariff. We would do it as follows. Here's a fictitious example, naturally. Let's say first zone of the tariff, the first 10,000 euro are taxed at 10%. The next 10,000 are taxed at 20%. The next 10,000 at 30%, then 40%. then 50%, and there we stop because everybody must draw a line somewhere. Even being greedy should know limits. How would that work then? Well, let's imagine a taxpayer has a total income of 15,000. Then, seeing our tax tariff, we would compute the total tax burden as follows. The first 10,000 are taxed at 10%. That is for 10,000, 1,000 euro. Now, the next 5,000 go into the 20% bracket, so they would be taxed at 20%, so 1,000 again. That leads to a total tax burden of 2,000 for 15,000 euro. If somebody is interested in an average tax rate, we can also say this is equivalent to an average tax burden of 13.33% for somebody with that income. We could, however, also look to a taxpayer with an income of 25,000. In that case, first 10,000 provoke a tax of 10%. The next 10,000, so up to 20,000, are taxed at 20%, so 2,000 euro. The next 5,000 are in the 30% bracket, so they will be taxed at 30%. That's 1,500. If we add that all up, that's 4,500. That leads, however, to an average rate of already 18%. And just to have another example, if our taxpayer in our fictitious tax tariff rule or regime has a total income of 45,000, we would compute this as follows. 10,000, 10% is 1,000. The next 10,000 are taxed under 20%, that's 2,000. These 10,000 with 30%, that's 3,000. And the fourth with 4,000, and the remaining 5,000 go into the 50% bracket, so that would be 50% of 5,000, that's 2,500. Altogether, that ends up as 12,500 if I did not make a calculation mistake, and that would now equal to an average tax rate of, only 27.77. So you see here, by the way, the average rate goes up constantly, but follows the marginal rate in the distance because it's always lower because of the lower tax burden in the first areas. Well, if you have understood how such a different zone progressive tariff works, you could naturally also simplify the lives of your taxpayers by directly publishing a list of what is the total tax burden for each total income. That would then look as follows. We might then have somebody computing all these things and publish a list. Here with our taxpayers, which we have, there would be an entry of 15,000 triggers a tax of 2,000 in total. 25 triggers for 5 in total, 45,000 triggers 12,5 in total, and so on. You might also set up a table where you publish the total income and link to that directly the applicable average tax rate, which results again from our original tax tariff function. Then you would just say 15,000 are taxed at a rate of 13.33. 25,000 at 18%, 45 at 27.27, and so on. By the way, in nearly all states of the earth, income tax rates and income tax computation is always made for a calendar year, not for a month or something like that. So when we talk here about progressive rates with regard to how high your income is, it's always the income from 1 year. Well, now you see how in which different ways one could publish such a tax tariff. However, you can only design it in one way, in the way how we showed it in the beginning, zones with increasing marginal rates and always applied to the next euro or to the next bracket only. Which kind of presentation of the tax tariff a state chooses for the publication of its tariff is merely a question of taste. As long as the underlying requirement for any progressive tax is still met, our first rule, it may never, or must never lead to a lower total net income if you increase your gross income. As long as this requirement is still met, you can choose every form of presentation in the law which you like to. For example, this here is the UK tax tariff for the current year of 2022-23. Here you see that the United Kingdom demands first 0 for a first bracket, then 20%, and then 40%. That's a very simple, however, a bit brutal tax tariff because, well, if you earn 1 additional euro, then your marginal rate leaps up from 0 to 20% or from 20 to 40%. That's probably not good for your feelings. However, it's a clear and very simple tax computation, and it fulfills our basic requirement because if you earn £13,000 in GB, then you will only pay the 20% on the exceeding, let's say, 429 not euros, but pounds. And so it's a very relatively low tax. However, I already indicated that some strange people might feel badly or strangely affected by such huge leap ups in the tax rate between the different brackets. And it might be that people say, oh, such an increase of instantaneously 10% for 1 additional euro in the marginal rate, that's a bit brutal. You could naturally avoid this by just increasing the number of brackets and reducing the difference between the different steps. So we could say we replace our fictional tariff by a more sophisticated one with more brackets and lower jump ups. Well, so that was our first idea of a tax tariff. Now, if we want to reduce the leaps between the zones, we just make more zones and smaller leaps here, for example. So we would not have a 10,000 bracket but a 1,000 bracket, and each bracket gets an increase in 1%. So we would have this, and it goes on and on until we decide that the marginal rate is no longer going to increase. Now, naturally, if you now have 1,000 brackets and you have a leap of only 1%, there will be somebody who says, well, an increase of a complete percent just when you have 1 euro more, that's harsh. So you might even regard this as too brutal, and so say, we make the brackets smaller and the leaps smaller again. So you would end up with a tax tariff with 100 brackets or so and a leap up of 0.1%, which then leads to a huge complicated tax tariff. Now, naturally, who was not satisfied at a small bracket of 1,000 and not satisfied with a bracket of 100 probably goes on until the whole process reaches a logical end. And the logical end of reducing the bracket width is just that you end up with an infinitesimal small bracket combined with an infinitesimal small increase in the tax rate. And this is probably your solution of choice if you are either a very capable mathematician, or if you are complete mad, or the most plausible alternative if you are complete mad and a mathematician. Now, for reasons which do probably only surprise German citizens, this is exactly the German choice. The Germans decided to have infinitesimal, you see I can't even pronounce the word, so the smallest imaginable bracket width and the smallest imaginable leap up in the marginal tax rate. So the German progressive income tax tariff is a set of mathematical formula because it's a bit difficult to write this down. Thousands of smallest imaginable brackets. So you ask a mathematician, can you design a function which automatically leads to a constant but steadily small increase of the marginal tax rate for each individual next euro or euro cent of your income? Now, it is completely unrealistic to publish such a tariff then in bracket zone form like the British did it. The only viable solution here is to publish a function which gives you the total amount of tax immediately for each given amount of the taxable income. And for this reason, we arrive at German tax tariff functions like the following one, which is, by the way, a tariff which has been published for the year of 2022, so the current year when this video is recorded. Here you see from 0 to 10,347, the total amount of tax is 0. Then you see the influence of the mathematicians and the madmen, because from 10,348 to 14,926, you can compute your total taxable income, your total income tax by using this formula. 1088.67 times y plus 1400 in brackets multiplied again by y, with y defined as your total taxable income minus 10,347 in brackets divided by 10,000. Now you see what the Germans have brought forward here is a very nice idea. We have a very gradual increase of the marginal tax rate, so that should feel very, very comfortable. But in real life, it sounds horrible because nobody who ever sees this function is first able to compute his own tax, to have an idea of how the tax function behaves. And so everybody has the idea that this is sheerly horrible. And so they wanted to create a tax tariff which is more modest and which feels better, and the final outcome is the sheer horror for all taxpayers. And so we even have the widespread opinion in Germany that people think, okay, if I earn €1 more, my net income will decrease, which is naturally, as we have seen, complete rubbish. Also, that leads to a very good protection of the jobs of tax advisors, because seeing that tax tariff, in contrast to the British one, everybody in Germany immediately has the conviction, I will never be able to cope with my own tax challenges. I need a tax advisor, or I should decide to become a tax fraudster. So, yeah. Why, by the way, sorry, do we have something in common between the German and the UK tax tariff? You have seen that both began with a zero zone. And this goes back to a very plausible idea, that is, taxes are usually designed according to the, and justified according to the ability to pay principle. Where somebody is able to pay taxes he or she should, we can naturally only take away at maximum the amount which that person would be able to pay, and that should be the tax base. Now, the problem is most states then say, we can't take away everything. We need to grant a free allowance for the basic cost of living for natural persons, because imagine a person needs 10,000 euro to survive in your country, then you can't take away anything from that amount of income as a tax, because if you did, then either your taxpayer would die. 10,000, you take 20% away, then 2,000, then it's only 8,000. Taxpayer can't survive, taxpayer dies, you don't have a taxpayer left over next year, so it's not a good idea. Or you would have to subsidize that taxpayer again so that that taxpayer can survive. So you would have to make welfare payments. These would in all probability have to be financed by the state. So you would take an amount of 2,000 euro as income tax, would then, under a highly bureaucratic procedure, decide to give it back to the taxpayer in question. So in the end, you took 2,000 euro and you could have seen in advance you couldn't keep it, you have to pay it back again. So that was a reason why most states say that's not a good idea, and we should design our tax tariff that this doesn't happen, so most grant a basic allowance for the survival amount. Now, in such a progressive tax system, we can again ask some nice questions. For example, how much must an enterprise produce before tax in order to be able to reinvest an amount of 10,000 euros? So if the owner is subjected to an income tax of 40%, or another owner who only pays 30%. Well, the first alternative will lead to a necessary gross income of 10,000 divided by 1 minus S. So 10,000 divided by 60% or 0.60. That would lead to 16,667 must be produced in order to have a net income of 10,000, or tax rate 30%. Necessary gross income to produce 10,000 would be only 14,285.71. So you would see here that there is a difference in the necessary productivity which you have and for the two taxpayers here if they are going to compete. So you can draw a first conclusion: in such a progressive tax system, growing your enterprise is made easier for small enterprises than for the already big ones. At least that seems to be the case when you only look to the tax tariff. However, such an interpretation can also be strongly misleading because imagine you have an enterprise owner with the zero bracket, and can he or she really reinvest more easily than the one guy or girl with 30%? And the answer is, well, in all probability, no, because our poor entrepreneur will have to withdraw all that income from the enterprise in order to finance the survival amount and the survival consume. So in contrast to the richer guy, there will be no reinvestments possible at all. And that is very often an explanation why such a progressive tax system does not hugely distort competition between individual enterprise owners, because in that area where the tax rates are already going up, are still going up, very often you still have a huge amount of private consume, so that the enterprise owners probably profit from a lower tax rate, but will still have to use much of it for private consume, so that the advantage which follows from, for a necessary net income of 10,000, I need a lower amount than my richer competitor, that this advantage comes not really into play. However, you must note that sometimes people, even experts who pronounce themselves in public on consequences of the tax system, are sometimes a bit far away from the world. Economists sometimes demanded an equal income tax treatment for all enterprises, with the argument that the lower tax rates for some of them distort competition between the enterprises, which is, if you closely look to the facts, probably just a misinterpretation, because as such a distortion can only be or mostly be created by different chances for reinvestment. Such a distortion cannot become effective wherever you can't reinvest but have to consume, and so this is very often a rather far-fetched idea. Okay, now let us include some modifications with regard to the existence of a trade tax in Germany into our calculations. What you need to know is that in Germany, as in some other countries of the world too, there is not only the income tax levied, but also a tax levied by the cities on the income from business. That is called the trade tax, or the original German term is Gewerbesteuer. This trade tax is, for some historical reasons, computed in a rather complicated way because it is based on the trade profit, which is a slightly modified income from business, multiplied by 3.5%, and then and only then multiplied by the city tax rate, which is set by the city council, usually in advance of the year. Well, um, that means that sometimes city tax rates, which sound absolutely horrible, for example, 400%, which is not an uncommon tax rate by cities in Germany, does not really mean a tax of 400% on the profit, but only 3.5% of the profit. So 400% city tax is a simple 14% of the profit. That sounds far nicer. However, naturally, one asks oneself, how do they do it in such a complicated way? And the reason is, as very often with things which can only be seen as nonsense today, historical reasons. The historical reason for that strange way to compute trade tax is that originally trade tax was based on three different components, but always taxed with the same city tax rate. That was the trade profit, the trade capital, so the equity of the firm, and the wages paid to employees. Now, naturally, you cannot simply add up profit, capital, and wages and then apply the same tax rate, because a tax on capital that can only be far lower than taxes on profit and so. So you had to make some weight factors. The three components were weighted with a weighting factor before they were finally added up and then multiplied with the city tax rate. The trade tax was modified with 3.5%. Originally, even some years ago, it was a smaller percentage, a higher percentage, sorry. The trade capital was weighted with 2 per mil, so 2 out of 1,000. Wages paid were also weighted with 2 per mil, and so the result was then the trade tax base. Now the trade tax wage tax was abolished from 1980 onwards, so that was eliminated from the equation. Then in 1998, the trade capital tax was also abolished, and so only the trade profit taken times 3.5% was left over. Now, a weighting factor is no longer really a good thing or necessary if you have only one component. So this change would have made the weighting factor superfluous. However, they did not abolish it. Probably it was the idea we don't want to write all the textbooks anew and things like that. And it always worked this way, so why change it? You know all these arguments. And so the trade tax profit is still multiplied with 3.5% before the city tax rate is applied. And naturally, if you ever talk to an outsider, a foreigner, or even a foreign person who is investing in Germany, and then just mention casually that the tax rate in your city is a harmless 400%, then your casual remark will also bring some casualties, because probably the foreigner directly gets a shock, leaves the city, or hides in a cellar until he or she can leave the country, because they think, oh, 400% tax rate, and the guy who told me of that was still smiling. That's such a horrendous country, I have to leave it as quick as possible. However, you now know it's simple 14%. So we can try to make a first assessment of the impact of such a special additional tax on income from business. However, our next calculation is not a fully correct one because of the findings which come out, the legislator decided to make some adjustment to the calculation, but you will understand them better if you first see what comes out if we just apply trade tax as it should be done in the simple way. So, what's the impact on the obtainable net income? You have a profit before tax of 100. You deduct the trade tax, that is with 400% local tax rate, that is 14% of the profit. You deduct income tax, and we don't bother about poor people, so we just think it's somebody on the top level of income tax, so 45%. So we have 41% left over. However, now what would be the consequence for the necessary gross profit to obtain, let's say, 100,000 net income from business? Net profit wanted would be this. Net income corresponds to 41%. That leads to gross income would be 100,000 divided by 41%. That is 243,902. So you would need more to obtain more than 240% of the amount needed in order to have a certain net amount given. Well, that's rather hard. Especially that becomes hard when you compare it to the necessary gross profit if an investor decides not to invest into a business, but into other sources of income where no trade tax is levied. For example, to invest in lease and rent property, so buildings and collecting money from tenants. So passive investments where you don't do much, just let your property work for yourself, have no risk and other things. So net income wanted there would be 100. Yes, you only pay income tax. Even at the top level, you would retain probably 55% because there is no trade tax there. So the necessary gross profit would be 181,818. So less than 60,000 or more than 60,000 less than in the other case. That would mean that the existence of a trade tax, at least at the level of rates of 400% or so, makes it necessary that a business investment is more than 60,000 more profitable than a comparable non-business investment. You can also express that differently. The productivity of a business must, under these circumstances, be by 34% higher than any other kind of investment in order to still attract investments. And well, that might be a nice idea if you have the idea that business owners are always the capitalists and the rich ones and so on. But the thing is, it is businesses where people find jobs and jobs are needed. So making investments into businesses less attractive than all other investments is probably not a good strategy in order to create and keep jobs and improve the employment situation. So that is why many people came to the conclusion such an additional tax on business income, which has its roots already in the Middle Ages, where indeed business people were strongly more rich than others, that such a tax should nowadays be abolished and does no longer fit to today. However, the problem is this is the only major tax which the cities can levy on their own and where they can freely determine the tax rate. And for constitutional reasons in Germany, the cities have a right to some independent taxation. And so an abolishment of the trade tax would only be possible if somebody would have a good idea what else could be given as an individual tax to the cities, and nobody found a solution for that. So an abolishment of that tax didn't seem to be realistic some decades ago. And when that became clear, the federal legislature of Germany tried to abolish that tax by a trick, to keep it in existence, but to make it unimportant for the business owners. What they decided on was taxpayers who paid trade tax were given a right to deduct their trade tax payments from their income tax liabilities on the underlying income from business. So it was a right-hand, left-hand transaction. What you gave to the city with the right hand was put back into your left hand by the federation fiscal authorities. So the federal government, in the final effect, reimburses now the trade tax payments to the business owners by a tax credit during income tax assessment. Now you can imagine what that means for a city council. In former times, when you had to decide about the city's tax rate, and you decided to say, let's replace 300% by 400%, you had to fear an uproar among your citizens, a revolution, and to get killed in the next local elections. Now imagine everybody now knows if the trade tax goes up from 300 to 400%, no damage done, because in former times we got reimbursed 300% by the federation. Now we get reimbursed 400% by the federation. So what would probably city councillors do? They would probably say, well, why not increase the city tax rate to 4,000% and buy some golden lamps for the streets? And a golden pavement, because it's better to keep the money here in the city than to give it to the federation. So naturally, that federation rule needed a kind of an upper limit. So it was at the time decided that the trade tax credit is limited to a maximum of 400%, because that was at the time the average tax rate levied by cities in Germany. And the idea was, okay, we are not going to tolerate that now a kind of a race begins who can levy the highest tax rate and ruin the federation. The idea was we compensate for an average tax burden. And if a city council then increases from 400 to 450%, then they still will face the anger of their voters, and that will keep them within a responsible behavior. Well, that's the background. So the actual consequences of trade tax for a natural person are then in reality as follows. You have a net income of 100 again. You have trade tax 420%, let's say. That's 14.7% of the income. You pay income tax, let's say 45, but you get a trade tax credit on income tax, that's 14, so the effective tax burden is only 31. Below the line, that leaves you with 45.3% of your income as net income. The amount then which is necessary to obtain a net income of 100,000 from business will therefore be, in such a city, 184, 162. This is now fortunately not considerably more than the amount which one needs to generate from an investment into lease and rent, where no trade tax is levied, because that was this 181,818. So indeed, yeah, 3,000 euro more. That seems manageable. It is only a small percentage additionally which you have to generate in comparison to lease and rent if you run a business. So that seems sustainable, tolerable. Okay. You should note, however, that this trade tax credit mechanism has only been established for natural persons, so for income taxpayers. It does not apply for corporations under corporation tax. So whenever in a city council an increase of trade tax from 350 to 400% will be debated, you will have still a clear opposition of some councillors against such an increase, namely those who speak in the interest of corporations, because for corporations, trade tax is still an effective additional tax burden. And naturally, you should know that the trade tax can strongly vary between different cities. For example, in Kleve, where I am at the moment, a very small city at the Lower Rhine area, there we have 417%. That at least is the rate for 2022. In nearby Düsseldorf, you have 440%, and in Cologne, you would even have 475%. So there are, by the way, even cities where you have 490% or 500%, and I heard rumors that there is one or two nearly bankrupt villages or so somewhere in Germany which have to levy 900%. Naturally, that is not really helpful for the economy. But now we can ask ourselves questions again like the following ones. An investor does not yet know if he should open a new shop with luxury goods in Düsseldorf or in Kleve. So he asks himself, how much higher must my gross profit in Düsseldorf be in order to make Düsseldorf equally attractive as Kleve or more attractive? The solution is simple. We compute the necessary gross profit for a net profit of 100,000 in Kleve. For this, we first need the net profit obtainable with 417% at Kleve. Gross profit is 100. The trade tax is 14.595%. The income tax is 45. Then you have the tax credit, 14 are paid back. And so we have a remaining net profit of 54,405%. That leads us to compare that now for Düsseldorf. Gross profit 100, trade tax 15,400, income tax 45. Again, we suppose that our taxpayer is already among the richest of the rich. Trade tax credit maximum is 14, so the net profit obtainable under best circumstances is 53.6. And now we can compute the necessary gross profits. For 100,000 net profit, we need a gross profit at Kleve of 183,806. For the same net profit from Düsseldorf, we need to obtain there 180,567. That means that Düsseldorf is equally good or better if we can obtain there at least 101.5% of the profit obtainable at Kleve. So if Düsseldorf allows you to make 1.5% gross profit more than Kleve, Düsseldorf is probably equally attractive or more attractive than Kleve as a location. And as it is probably plausible that if you try to sell luxury goods, then in Düsseldorf you will have probably more and richer customers than in Kleve. I don't know, at least I am not one of the richer customers, so I just suppose there are less rich customers here than in Düsseldorf. So probably our investor chooses Düsseldorf as a location for his new shop. And yeah, indeed, in Kleve there is nothing like Königstraße in Düsseldorf. So perhaps our interpretation here is correct. Well, you could even compare the attractivity of two investments in Cologne and Düsseldorf with each other. The gross income in Cologne would be 100, trade tax 470% leads to 16.45% trade tax, income tax maximum plus trade tax credit repayment, maximum is 14, so below the line we have 52.55%. That means the gross profit needed to generate 100,000, net income is 190,294. And if we make a comparison now, that means that an investment in Cologne must generate 101.998% or so, so approximately more than 2% more than a comparable investment in Düsseldorf can generate in order to be more attractive than a location in Düsseldorf. That seems possible. However, I warned you, sometimes there are some considerations which are relatively far-fetched, and you should not overinterpret the results. For example, especially in the case of Cologne and Düsseldorf, whoever knows the two cities know that they have a kind of a traditional despisal or rejection of each other. It's great fun, nobody takes it serious, but even at least officially and in the carnival season, when you ask somebody from Cologne, he or she would regard the complete question as completely far out from the world, because he would tell you that somebody from Cologne would, even without our calculation, never, never, and never consider to invest in Düsseldorf. And the other way around, somebody from Düsseldorf would always tell you, well, I would do many things in my life, but never, never, never speak to or invest in Cologne. So I don't know why I just told you this, but it's a kind of a local tradition. So at least the calculation shows you why this fixation on avoiding each other's cities will not completely ruin our taxpayers, because it's viable. Okay. Now we might even modify the calculation a bit more, because in addition to trade tax, there is also sometimes a church tax in Germany. So the background is, if you are a member of a Catholic or Protestant church or another of certain religious corporations, you can be obliged by your church to pay a church tax. So that corresponds to 8 or 9% of your income tax. So it's indirectly progressive, because as the income tax of the rich is higher than the income tax of the poor in percent, also 8 or 9% of the income tax is a higher percentage of your income in case of you being rich, or in comparison to you being poor. Now, the church tax, however, can also be deducted from your taxable income as a special personal allowance, a so-called Sonderausgabe, because it is a kind of an unavoidable private expense. You can't tell a religious taxpayer, well, you can just pay more taxes if you just cancel your membership in the church and then, according to your own convictions, later go to hell. So it's an unavoidable special expense, which should be taken into consideration when you measure that taxpayer's ability to pay. Under normal circumstances, they can't avoid this tax, so it lowers their available taxable income for other purposes. And if you take that effect into account, then the additional impact on the income is relatively lower and amounts to only approximately 387% or so of the income. I hope I calculated that correctly, but it sounds realistic. Okay, so if we take now church tax obligations into consideration, then we can again ask the question, how much net income remains for somebody who runs a business in Cologne and is a member of a church. Then we have profit 100, we have trade tax 475%, that's 16.45. We have the trade tax credit, that brings back 14. We have the income tax maximum 45. We have the trade tax on that 45 with a net effect of 3876. We have, for this reason, net income remaining 48.67, 4%. And we can ask that usual second question, how much gross income does that person need to generate in order to keep 100,000 as a net income? And that would the 205,044.49. To compare that with a non-believer, or at least a non-member of a church, that person would need to generate 190,294. So the church member needs to be approximately 8% more productive than his non-religious competitor. Yeah. And so might be, let's say, if you're being a member of a church and having religious convictions motivates you to be 8% more productive, then it evidently pays off, which might be, don't know. Or might be that God himself takes care that you are 8% or 10% more productive than the others to bring some fairness into the world. So, yeah. And in practice, you see most of these people don't break down, so it seems to work in a certain way. Last but not least, we might also ask some questions concerning the comparison of investments in different countries. For example, if there is a foreign country which offers an income tax rate of only 20% for investors investing in the same industry or sector which we taxed at Düsseldorf. How much more productive must Düsseldorf be as a location for such an enterprise in order to be still attractive for that kind of investment? Well, let's say we take trade tax into account but neglect church tax, and we just assume that abroad there will be neither trade tax nor church tax, so that 20% is indeed their effective tax rate. In that case, the gross income in the foreign country will be 100. The tax will be 20%, so the net income is 80%. So a gross income of 100,000 can be generated by a gross income of 125,000. The gross income needed at Düsseldorf to generate the same net income was, as we have calculated already above, 180,567 euro. So that would be approximately 49.25% higher than the gross income which you need to produce in that foreign country. Or you could express it differently. The foreign country must produce less than 67% of the profit obtainable in Düsseldorf to be less attractive than Düsseldorf. However, in practice, you very often have constellations like this due to bad infrastructure in such a tax haven and other local productivity factors. For example, it might even be that you have a foreign country with a zero tax rate, and still Düsseldorf might be more attractive for investors because just the gross profit obtainable there is, even if the other country has a zero tax rate, that even the gross profit there can be more easily produced than the necessary gross profit in the tax haven country. And this explains why countries with different tax rates can coexist without that one of the two countries immediately goes bankrupt, as long as the location in the high tax country can be equally productive or even more productive than the low tax country. There will be no harm done, and the investment still happens in the high tax country. And if there is a shift, then probably it begins in only one branch of economy and does not immediately spread to all sectors of economy, so that indeed open borders with different tax rates in every country is a model which can work and works worldwide. Okay, so far so good, but you should remember that until now we have only dealt with one of the aspects of a progressive tax system, or only one of the rules, and then directly indulged in calculations and analysis steps Just to remind you of that first rule which we have set up, there must never be the case that a higher total gross income leads to a lower total net income. So that was the rule. You can only increase the marginal tax rate, but nothing else. However, there are also other questions which need to be solved when you design a progressive income tax system. For example, how high will you set the highest marginal tax rate of your country's income tax? And well, there is no clear answer to that. You can already see that from the fact that different countries have very different income tax tariffs. Now, how can we explain that, or at least which rules can we find for this? Well, we can establish some basic principles. First, 2.1, the top rate must never be 100% or higher, because in such a case, we would have the decrease of the net total income when the gross income increases. That would be self-destructive, because then your people would have no incentive to produce higher income and consequently no incentive to generate a higher income tax revenue for the state, and so that is something which no state will undertake. A top rate must also take into account the existence of fraud as an alternative to tax honesty. What does it mean? Well, imagine that our tax rate is 90%. Then when you work 1 hour, you have a gross wage of 100 euro or units of your local currency. And that leads to a net income of 10. Now you have two alternatives if you want to increase your net income to 100. You can either invest 9 hours into honest work, pay the tax, and then you have 10 times 10 euro, that is 100 euro honestly taxed money. Or you can invest additional 8 hours, 9 hours, or 8.9 hours into hiding your original gross income of 100 euro from the tax, or investing all that time into finding legal ways to avoid paying taxes on these first 100. Naturally, you will see that probably when there is the slightest possibility to escape the tax, if it is more promising to invest 8 hours into avoiding a tax than working additional hours, then you have a very, very high incentive to commit tax fraud. On the other hand, when the tax rate goes down to 5%, this relation already goes down considerably. When you work for 100 euro and have a gross income of 100 now in your hands, that equals a net income of 50. Now you have two alternatives: either to choose the uncomplicated and honest way to just work 1 second hour for 100 and pay taxes honestly, then you have twice 50, so the desired 100 euro net. Or you can invest again time into hiding the original 100 euro gross income or finding ways to escape taxation, but then economically you have only 1 additional hour at your disposal for that. If you invest 2 hours, for example, in that, it would be less attractive than simplifying the procedure and working honestly. So the higher you set your rates, the more attractive economically tax fraud will become. And a third aspect is your tax rate must also take into account the ability of the taxpayers to shift their activities to other countries. Sorry, the cat. So a country. Let's have a break. Okay, now after the small cat break and with some feed of my cat on the keyboard, we can only try to go on. So, where was I? Okay, the tax rate must also take into account the ability of your taxpayers, if they have it, to move their activities to other countries. For example, if your country A has a tax rate of 50%, but an immediately neighboring country has a tax rate of only 10%, then most of your taxpayers will dream of moving their residence and their activities into that cheap country B, if that is a possible and viable alternative for them. That, for example, depends on the possibilities to move there under, or if there are legal restrictions for free movement. That depends on the language and other things, or the living circumstances for them in that other country, and all that. That that ability of taxpayers to escape from their own tax system to another country explains, by the way, probably why there are several countries where the tax rates for income from capital are lower than the tax rates from other or on other kinds of income activities, because capital investments can usually be shifted abroad far easier than other activities. For example, bank accounts can be easily opened, and so interest can be easily collected in other countries. And hiding these activities from your local home state fiscal authority had been for a long time very easier or than hiding other activities. That very often motivated some states to make special rules for the taxation of capital income. The idea was just it might be better to get 25% on capital income actually than hoping for 50% on capital income, which you never get. So setting the top marginal rate for income tax has to take some aspects into account, but has no clear outcome. So it's a political decision. There is a trade-off between several effects. A state or a political system has to decide which risk resulting from a top rate they are willing to take, especially with regard to the fact that if you decide for a lower tax rate, then that costs you tax revenue, but that if you set a too high tax rate, that also costs you money, because then your taxpayers try to escape the tax. So these were my small remarks on the determination of the highest tax rate, and naturally the medium tax rates will follow some path in between from 0 to the highest tax rate. That's also kind of a matter of personal discretion of a state, so also there is no general law for that. Okay, now we up to now, first we can still sum up that there are different solutions in practice. I looked it up. The highest income tax rate in Germany at the moment is 45%. You know that already. In former times it had been 56%, 50%, or decades ago even more. The marginal rate in Denmark is capped at 55.9%. The highest income tax rate in the Netherlands is 52%, approximately the same rate as Sweden. The small Principality of Liechtenstein has 12% plus 12% local tax, if I correctly understood it, which is probably not the case. The income tax rate in France goes up to 41%, and so on and so on. So here you see approximately all the same region, but probably two cultural aspects. And you should also take into account a fourth aspect. If the tax rate is too high, people then also think about, well, I renounce on working for more net income. I just prefer leisure time over additional working time. Also, that might play a role. So you have a false effect. Well, now what we have not yet talked about is the treatment of corporations, because until now we have only talked about the tax rates of income taxpayers, and so about corporate taxpayers we have to talk and think now. So let's talk now about the treatment of corporations and have a look which peculiar aspects come into play here. The first evident thing is you will expect no subsistence or basic free allowance there, because juridical persons don't have a life, so you don't need to keep them alive, so it's not necessary to give them a free allowance for the costs of survival. You can tax them from the first euro onwards. Second, there will be very often or even usually no progressive tax rates. To understand this is a bit more complicated, but only a bit. The basic idea is plain and simple. You could easily avoid progression just by not establishing just one company, but establishing 5 or 10 or 2, and then distributing the profits equally among them, so that each of the companies ends up in the area of a low progression. So basically, imagine if the corporation tax tariff would be progressive, as in my following example, going up from 10 to 50%. Then if we expect to make a profit of 500,000, then the easiest solution would be just to establish 5 companies instead of only one. Take great care that each of the 5 companies makes a fifth of the profit, so 100,000. And surprise, all my profits go away with a tax rate of 10% only instead of 50% altogether. And that means a progressive tax tariff construction for corporations can probably only work in cases where the costs for establishing a second additional company would be higher as the cost from the increased tax rates. And yeah, sometimes there are also, or not sometimes, but always, there are certain costs for setting up a second company, and also certain current costs for annual bookkeeping, administration, accounting, publication of financial statements of a corporation. So there might be some constellations where a progressive tariff might work, but in many cases, splitting up companies would be easy, so that a progressive tax tariff could be circumvented easily, and so would in the long term be doomed. Yeah. So let's have a look to this example. If we have a progressive tax tariff of this structure, probably it might work, because this tariff has a relatively small first bracket, and the difference between the tax rates between the first and second bracket is also relatively low. So in order to multiply the first bracket and to set up a second company, we would only, by doing this, we would only save 5% on 20,000. That would be 1,000 euro. The additional costs for setting up a second company will be considerably higher. Probably already the current bookkeeping is far higher in the costs, so probably such a tariff might be able to survive. On the other hand, if we look at this tariff, this is far more doubtful, because here the first bracket is relatively large and the tax rate difference is relatively high. So if you set up a second company which also has a second first bracket, then you save a total tax amount of 20,000. That could already be less than the current administrative cost of setting up a second company. It strongly depends on what you require, what administrative things are required in the real world, but you see how that probably is the connection. So to sum up, a progressive tax tariff for corporation tax is highly implausible, at least, but you cannot use under no circumstances the same tax tariff as for income tax. the top rate of corporation tax will very often not be identical to the top rate of income tax, but lower or even far lower. That is another surprise which you probably will have. So that's a riddle. Because imagine if you earn some, let's say, 500,000 euro, Germany would demand that you pay 45% income tax. However, if you are a corporation and earn much more, your rate is much lower. So the corporation is much richer, but the rate is much lower. Isn't that unfair? So if you look through the corporation tax rates at the moment, 15% in Germany, France announced or planned 25, UK talked about 25. Here we have a split tariff, small companies 19%, corporation tax in Ireland 15%, corporation tax in Spain 25% very often, but very different rates for different sectors of economy and different legal forms. So rather more complicated. But what you can see under all circumstances is that we have relatively low rates in comparison with the top rate of an income tax, which we would expect. So why is that the case is logically our next question. So, yeah, you must keep in mind the following things. With a capital company, we have usually the following course of events. That is, first the company makes a profit, so then it pays corporation tax. And later, it pays out the money as a dividend to its shareholders, and then the shareholders pay income tax on these dividends. So in the course of time, the underlying profit will be taxed twice. Yeah. Now, the alternative would be to run your business as a sole trader, and a business run by a natural person, so, however, would only pay once income tax when the profit is then made, and later nothing happens anymore, especially when you take out your own company, your own money from your own business. That does not trigger any tax again because it's not a dividend. It does not make you richer anymore because you already own that money and you taxed it already. So no taxable income anymore, no tax anymore at the second step. So after these things, we can sum up the problem as follows. When you see the corporation and the natural person as alternatives and making the profit and distributing the profit as two different steps, then in case of a corporation, you have first corporation tax when the profit is made and dividend income tax when the dividend is paid out. With a natural person, you only have income tax and then no tax anymore. So to compare it, you have two taxes in comparison to one tax. And now, which of these two alternatives would you prefer if corporation tax would have the same top rate or the same rate as the top rate of income tax? Then naturally, if you can choose between an alternative where you pay one tax and where you pay two taxes, you would prefer the one tax alternative. So this whole system can only work if the total tax burden on the both levels in case of a corporation together is roughly the same as in case of rich natural persons. Otherwise, nobody would ever establish a corporation. So for this reason, states usually design their corporation tax and their income tax rates on dividends in a way that if you put both together, they roughly equal the income tax rate for wealthy business persons. So how can you achieve this? Well, if you look to the corporation tax level again and to the income tax level again, you might make a solution which is a 50-50 solution. Corporation tax is set as 50% of the top rate of income tax approximately, and for dividends you charge a reduced rate, let's say 50% of the regular income tax. There you have together 100% of a regular tax, and that was the German solution until 2008. Later the Germans played around a bit with the weighting factors on the two levels and said we should reduce the corporation tax a bit, so that from an international background Germany sounds more attractive. So they pushed down the corporation tax level to approximately 40% of the average expected tax rate of a wealthy taxpayer, and then said, well, in combination with that, sorry, I looked for the word and didn't find it. In combination with that, then 60% of a dividend will be taxed, or a dividend will be taxed with 60% of the regular rate. This then leads to, surprise, approximately one full tax burden again. This is the German tax solution since 2009. You can, however, choose all other weighting factors which you dream of, as long as you end approximately at one full tax, or a bit lower or a bit higher doesn't really make a damage. But if you have, let's say, 0% tax on the corporation level and only tax the dividends, that would also be a viable solution. That would be the Estonian solution. I don't know if they still do it this way, but that country did it at least for a time this way. You might also choose the other alternative, just tax corporation tax at the top rate of income tax or near the top rate of income tax, and then renounce on dividend taxation. That is the old Greek solution. So many other solutions are imaginable, as long as in combination they lead to approximately the same tax burden as a sole tradership has to experience. Well, so that is how corporation tax rates are usually determined, and how they are combined with the income tax rate for dividends, so that a convincing total comes out. This mechanism, which decides how corporation tax and dividend tax on income work together, is, by the way, called the corporation tax system of a state. So when you ever hear about this, that a certain state has a certain corporation tax system, then you know this. Now, as the corporation tax system only necessitates that there is a rough correspondence of the overall tax burden of a comparable sole tradership in the company, there might nevertheless be small differences, and so it might be interesting to calculate the tax effects more closely in order to find out which legal arrangement is the best, or what limited liability costs you in addition to the sole tradership, or if it's even more attractive, and things like that. So a mass of interesting questions can be answered. So first, naturally, we need the necessary data for the German tax situation. The corporation tax rate in Germany is 15%. That is now the year of 2022. Just in case if you look this video, let's say in 10 years, things might have changed. 15% in 2022. Trade tax is fully levied. There will be no tax credit for corporations. So 3.5 times the city multiplier are fully an additional tax burden for the corporation. And the income tax on dividends is then a flat rate with 25%. In all cases where the investor is a private investor, so where the dividend is classified as income from capital. Wherever the dividend ends up in another type of income, for example, if the investor is the owner of a business and holds shares as a part of his own business, so owns a subsidiary company in his own sole tradership or things like that, then the dividend might be classified as income from business or another type of income. Then you get a 40% discount on the tax of the dividend, because 40% of the dividend amount are then declared as tax-free. As a background, I already told you that the corporation tax is approximately 40% of an estimated 40% tax rate of an average wealthy taxpayer with 40%. So that would lead to 60% tax rate, rounded down 50. And the income tax on a dividend corresponds to roughly 60% multiplied with an income tax rate of 40%, again would be 24%, rounded up to 25. That explains the figures. Well, so let's ask some questions and make some calculations. Which net amount, for example, will remain if we invest in a German company in a city where the city multiplier is 400% for the trade tax? The gross profit would be 100. The corporation tax goes up, goes down, or is subtracted with 15. Trade tax 3.5% times 400%, it leads to 14. That leads to a subtotal of 71. That is then the maximum which can be paid out as a dividend. And from that dividend, 25% are charged. So what remains is, for this reason then, 53.25. And well, this computation was a bit simplified because in Germany sometimes there is still levied a so-called solidarity surcharge and also a church tax. Both have been neglected. And yeah, with the information we have just now, we can also find out how much money must be created as gross profit so that an investor can retain a net amount of 100,000. That would be 100,000 is wanted divided by the net income percentage. So we end up with 187,793 euro. That is very much in the area which we know from sole traders too, when we think a bit some minutes backwards. You can also now do some nice calculations. For example, how much net profit remains from the profit generated by a company located in Cologne, where the trade tax rate is 475%. Here again, gross profit would be 100, corporation tax 15, trade tax 16.45. That leaves us with a subtotal of 68.55. That is at the same time the maximum which can be paid out as a dividend. 25% of that is 17.13. So where that leads to a net amount of 51.41.25. Again, we have neglected solidarity surcharge and church tax. However, church tax is probably not a big issue because some people don't pay it, and naturally, the capital company, the juridical person, can never pay it because a juridical person cannot be a member of a church. So these are a bit simplified numbers. However, well, they give us a good impression. Now, if we want to check which gross amount does this correspond, if we need to obtain 100,000, then we end up with 190,475. So our investor from Cologne probably needs to generate some 7,000 euro gross income more than his competitor in a 400% city to be as attractive to investors than his competing enterprise from the 400% city. Yeah. However, you can also, and that's the important thing here with the corporation tax system, you can also now look to what happens if you do not intend to distribute all the net profit as dividends, but intend to keep it inside the firm. Let's again compute that based on a trade tax rate of 400%. So in that case, we have a gross profit of 100, as always, 15%, 14% corporation tax, 71 are left over, and then that's it. The tax amount for the dividend will either come very late in the future, so that its discounted present value is probably near zero, or it never comes. For example, if you manage to keep the money in the firm until at the end of eternity, that firm goes bankrupt. No? Now, that brings us to a question. Under which circumstances and when is which legal form best for a certain enterprise, sole tradership or capital company? So in a city with a trade tax rate of 400%, you end up with the following calculations. Sole trader would generate 100 euro, pay 14% trade tax at 400%, obtain later a trade tax credit, again at a rate of 400% at maximum. So that trade tax is here not a real influence factor. Income tax rate, let's say, is 45%. That's rather harsh. And then still 55 remain. For a company, the gross profit would be 100. You deduct the 14, the 15, and so on. You end up with 53.25. So here the sole tradership has slightly the better outcome under the condition that all the income produced is paid out as a dividend. However, what if you intend to keep all the profits in the firm and reinvest them? For the sole tradership, nothing changes, because there it plays no role if you withdraw the profits or keep them in the firm. For the company, however, we would finish the calculation at the level of 71, because dividends are not paid, so we don't have a dividend income tax. So now 71 units can be saved up as retained earnings. And so in this constellation, opting for a company seems to be far better if these are your plans. Now, under realistic circumstances, the choice might be a bit more difficult, because under realistic circumstances, you will have a certain amount which you need for your own consume and can only leave the rest in the firm. Now imagine our owner expects to make a profit of 1 million and he thinks he will only need 100,000 for private consume. So what is the outcome? So in case of a sole tradership, we would have 1 million, pay 140,000 trade tax, will recover them by the trade tax credit. We pay income tax according to the 2022 formula of this year. We would pay 432,328, so that we have a net result of 567,712. In case of a company, you could, however, if you only distribute an income, a dividend of 100,000, you could end up with a net amount of 695,000 euro, which then can be used 75,000 for consume and all the rest for investment in the firm. By the way, we could dispute the calculation a bit, because in my case you pay out 100,000, pay 25%, but if our owner really wanted to have 100,000 in the end for consume, you would have to remodule the calculation in a way that the net amount received by the owner is not 75,000 but 100,000. That would correspond to a dividend payment of 133,033, and then a capital income tax on dividends of 33,333 and many threes. So that depends on how you formulate your requests. However, as the case stands here, opting for the foundation of a company when you intend to save up a major amount of money, as retained earnings seems to be far more advantageous, not in the long run, but always in the short run. Now, what if our taxpayer has a more complicated situation? Expected profit is 300,000, so congratulations. But also, our taxpayer has a huge family, 10 children with 10 free allowances of approximately 5,000. I could look it up and give you an exact figure, although that figure, due to inflation, changes every year, so it would just be a kind of a game to look up the exact figures. So let's imagine if you have 10 children, then you get a free allowance of 5,000 approximately. That's realistic. And now every taxpayer in Germany also gets deductible special allowances, so-called special personal allowances or special expenses. The German word would be Sonderausgaben. So you can deduct that from your income tax base and only pay taxes on the rest. What would be the outcome in such a situation? In case of a sole tradership, our friend would earn 300,000 income from business. The allowances for the children and the other personal allowances would be deducted for the computation of income tax. So your taxable income for income tax would be 230,000 only. Trade tax, however, would be calculated on the full amount of the profit from business. 400%, that would be 42,000 euro. However, as you know, as an income taxpayer, your trade tax burden would, at least at the level of 400%, be compensated by the trade tax income credit. And so in the end, you end up only with the burden from income tax, that's 85,828. So your net result would be 214,712. In case of a company, the gross profit would be 300,000, and companies don't get free allowances for children and other stuff because they can't have one. So the taxable income for the company would remain 300,000. The trade tax and the corporation tax would be fully paid, already 85,000 together. And so already nearly as much as the income tax in that case. And you would then have to pay out the remaining amount as a dividend, 53,250. So the net result here would only be 159,750. So here we have already more than 50,000 difference between the two legal forms as an alternative. So highly unattractive in that case. So choosing a GmbH would here be considerably worse than being a sole trader. However, sometimes when you have two extremes, it might even be better to combine the two things together. And for example, is there a way to get the personal allowances and nevertheless only pay corporation tax and trade tax on the retained earnings? And the answer is yes, that might be true. You can try to do it because a shareholder is a person, your company is another person, and two persons can make contracts, and these contracts are valid under civil law. And as far as these contracts also are conform with market conditions, they will also be accepted by tax law. So our shareholder could, for example, take up a job in his own company as an employee, retain a wage, which is market conform, and then things might change a bit. Because the GmbH now, let's imagine our shareholder works for a job as a manager, 80,000 as an adequate salary, which is really market conform, so no debate about if it's okay or not. It is okay. Tax advisors told us so. So the GmbH's profit calculation changes now. 300,000 minus the wage, so the gross profit from business goes down to 220,000. The trade tax now is levied on that profit, 30,800, and the corporation tax also on that profit, 33,000. Then we retain 156,200, and the dividend on income tax on dividend, not dividend on income tax. Oh my god, what a day. So we stay with a net amount of 117,500, which can be obtained by paying the money out. Otherwise, if you leave it in the firm, it's 56,200. Our owner, however, gets 80,000 paid out from the corporation, deducts 50,000 free allowances, special expenses 20,000, remains with a subtotal, so taxable income of 10,000. The income tax for a taxable income of 10,000 is 0, so what remains net for him is 80,000. So we would have a net amount of 197,500 in case of distributing everything as a dividend, and we would have 236,000 if we just decide to not pay dividends but keep everything in the firm, apart from the money which we gave to our shareholder and which he needs to support his family and pay his unavoidable personal expenses. From examples like these, you can see that informing yourself thoroughly about the potential scenarios might bring financial advantages, and naturally, especially working with contracts of this kind is very frequent in arranging your tax situations or in optimizing your tax situation. Especially international tax planning operations use that same very simple basic principle of concluding contracts with different groups, different persons of the same group, but always arranged according to market conform conditions so that nobody can really complain. Just to give you a short example about how that works. Imagine you have a company in Germany, then this earns 1 million revenue here. And now you have a sister company in Ireland where they have or plan to have 15% corporation tax, but they have no trade tax there. Now this company in Ireland holds a patent right which the German company needs. So the German company will pay a market conform license fee to its Irish sister company. Let's say the market conform price is deemed to be 100,000 in our case. Then the German profit goes down by a business expense of 100,000. So the German tax base goes down by 100,000. That means also the German taxes go down by 15% on the 100,000 and by 14% trade tax on the 100,000. So the German total amount of taxes goes down by 29,000. We have, on the other hand, now a business revenue in Ireland, 100,000, and the Irish taxes will go up by 15,000. And if we look together on that, we have a net effect of taxes dropping by 14,000 just by cleverly arranging who holds our patent rights in the group. If the company in Germany had held these patent rights themselves, then the effect would not have been possible. And that is what very often people do in international tax planning models. We can even now ask again some international question and could, for example, calculate how much money a German company in Munich must produce as gross output in order to be still equally attractive in comparison to a foreign company in a country where the tax rate on income tax is only 10%. So if we have a look to that, then the gross profit produced in Munich would be 100. The trade tax would be 17.15 because the trade tax city multiplier in Munich is 490% in the year of 2022. Corporation tax is 15 as always, so the net amount remaining is 67.85. That is at the same time the maximum dividend which the investor can obtain. 25% German income tax on that dividend is 1696.25. So the net result would be 50%, 88.75. Again, under neglecting church tax and solidarity surcharge. If we take that figure to compute the necessary gross amount, then we would get the result that we need 196,512 gross income to produce 100,000 net, which the investor can obtain, can use for private consumer. The foreign alternative leads to the following figures. The gross profit is again 100. We deduct the local corporation tax of 10. We end up with a net result of 90. We have a maximum dividend of 90. When that dividend is paid out, in the end, German tax law will apply to that dividend. So we have 25% on that to pay. That's 22.5. We have a net result of 67.5. And if we take that into account, we need to produce only 148,148, which now means that to be comparable to the foreign investment, the company in Munich must produce 190,512 divided by 148, that is 132.65% or more of the output or of the gross profit of the foreign company if it still wants to be competitive with the foreign investment location. Very often, however, that will be the case in real life, because very often, as you know, the productivity in so-called tax havens or tax oases in foreign countries is due to a very low infrastructure, low educational level, and other low things, very often still very low. You know, perhaps some person whose name I've forgotten once coined the nice statement that a tax oasis is often under market aspects a desert. And that is perhaps why Munich still can attract some investments. Yeah, now let us talk about some questions concerning the tax base. And I hope you remember our trivial formula in the beginning of this part of the lecture. That was the tax base multiplied by tax rate is the tax amount. And we have now, until now, spoken about the tax rate. Now this will be about the tax base. So, ideas concerning the tax base. What can we try to find out? Well, the tax base is defined as tax on net income. So income is defined as revenue minus expense. And it's the expense where we will look at first. So the first question, which expenses will a state allow to deduct from the revenue, and why is this a very vital question for businesses? So will it be all expenses? Will it be private expense, consumer expense, business expense? What will be deductible? Because you need a definition for expense in our equation and chart, which we just have seen. So the answer to what can be deducted is in most states similar. Deductible expenses, most often the expense which was spent in order to achieve taxable revenue. For example, in German law, you will find definitions like business expense is the expense which is caused by business, so caused by business is sufficient for deduction. Or if it has to do with some other type of income, you find the term income-related expense. And there we have a definition that income-related expense is the expense which was incurred in order to obtain. So again, the cause is the necessary thing. In order to obtain, secure, or maintain the revenue. Paragraphs 4.4 ESTG and 9.1 ESTG respectively. And both definitions are, in spite of the different terms, interpreted by the courts in a way they practically mean the same in all situations. There are other states where you don't have a general definition, but a list of deductible expenses. However, this list has nowadays usually grown more and more to an extent where nearly every expense or absolutely every expense is covered, which is caused by the business or the income generating activity. And this similarity of the definition of expense in most advanced income tax regimes raises the question why. There is no overall authority above the states which could dictate them how to define the deductible expense, and nevertheless there are massive similarities everywhere. So if everybody tries to find solutions on their own, how is it explicable that they all end up with very similar solutions? And this, I think, is a very, very interesting question, because if you see something like that, then there must be a very, very good reason behind that. Otherwise, this similarity could not be explained. So let's look for a way to find an answer. And the best way to find an answer for the question, why is a legal rule the way it is just eliminate that legal rule for a moment. Imagine that rule would not exist in the way as it exists today, and then have a look to the world and what does the world then look like? And then very often you can find out why the rule is as it is. So let's imagine first that the income tax rate in a country is 50%. Now we change the rules a bit and declare a bit of the expenses, a certain kind of expenses, so to be non-deductible. So it is not qualifying as expense for the purpose of tax law. It does not enter into our calculation. Revenue minus expense is taxable income. So here we have now a revenue of 100. Now our business owner really spent 95, but under the taxable income catalog, only 90 qualify as deductible expense. So the result of our activity after tax would be now which one? Let's calculate the tax. For taxation, we have revenue of 100 and we have acceptable expense of 90, so we have a tax base of 10. And that leads us to a tax resulting of 50% on 10, that's 5. So when we now compute what our actual net profit has been now, we obtained a revenue of 100. We have actually spent 95, although only 90 were accepted by tax law. Nevertheless, you spent the 95 in reality. Then you also have to spend an income tax of 5, so you end up with a net profit of 0 after tax. And this means that even if only a very small portion of the expenses which an entrepreneur or business owner, or however you call them, makes is not deductible from the tax base, the activity in question will soon lose all its attractivity for the people acting in the economy. Because we can probably agree that if you earn 100 and have nothing left in your hands after that activity, if you can foresee this with reasonable plausibility, you will never undertake any effort to produce this income. So what we have here on our chart is simply an economic ban on undertaking this activity. So our people will stop generating income. No income will be generated. No income tax will be paid at all. The state forbidding the deduction harms itself. So we see that already when a very small percentage of the expenses which you incur in practice is not deductible, we have a huge damage following from that for the economy. However, this effect naturally, in my example, depends on several things. For example, the effect will be less compelling as long as the tax rates are far lower. Imagine another extreme. The revenue is 100, the expense incurred actually is 95, but tax law only allows you to deduct 90, as in the previous example. But now the tax rate is 4% and not 50%. 4% was a tax rate which was really existing, let's say, around the year of 1900. At that time, levying an income tax of 4% was, by the way, by the population regarded as outrageous. But now let's look what would have happened under such a system with non-deductible expenses of 5. The tax calculation is now, the tax base would be 10, the tax would be 0.4. Our net profit would be 100 minus 95 effectively spent by us minus 0.5 as tax. So we have a remaining net outcome of 4.6. We could live with that. Probably nobody would complain if a small amount of the expenses, which we in reality have incurred, would be crossed out from the list. We would probably not even realize the full effect because tax rates were low. However, tax rates today are not low anymore. Now, if you compare that result with a competitor or an alternative investment where all the expenses are deductible, also then the effect would be interesting because the tax base where everything is deductible is only 5. The tax would be 4% of that, that's 0.2. The net profit calculation would be 4.8. So with very low tax rates, also the distortion between investments where everything is deductible and investments where not everything is deductible is approximately very low. This explains perhaps why in former times where there were low tax rates, there were sometimes countries which made a list of deductible expenses and the rest was not deductible. So where you had no explicit permission, you could not deduct, and nevertheless economy flourished. But today, where tax rates have gone up and profit margins have gone down, and probably this would no longer work. So yeah. Naturally, the impact of non-deductibility will also be different depending on the percentage of the non-deductible amount with regard to the complete amount of expenses. Imagine that the revenue is now 100, the total expense is 70 only, but non-deductible included in the 70 is 35. In that case, tax law would only accept 35, the other 35, as deductible expense. So tax law would just fictitiously say that your profit was 65, although in reality it was only 30. If now your tax rate is 50%, then 50% of that fictitious 65 would be 32.5. And the net profit calculation would be you had revenue of 100. You had to pay, or you paid 70 as expenses, you paid 32.5 as a tax, so you made a loss. So in that case, the non-deductibility of certain revenue turns the profitable activity before tax into a loss after tax. So evidently, either this activity dies out in such a country, or the rule about the non-deductibility of the expenses will die out or will be strongly cut back. There is no other way how that system could survive. If the tax rate is lower, however, then the effect also is a bit more moderate than the fictitious gain of 60 or profit of 65 would lead to 19.5 as profit tax. Our net profit would indeed end up with a small net profit, 10.5 still. However, then the distortions in the market with regard to other investments where everything is deductible under your tax code would be stronger, because if other investments are taxed on their actual expense base, there Then tax law would say they only have a profit of 30, as they actually have. The tax would be 30%, that's 9. The net profit would be 21, and that would be double the net profit, twice the net profit which you obtain in the other case where I made a huge portion of the expenses non-deductible. So where we have a huge portion of expenses non-deductible, there is a certain plausibility that you will have strong distortions in the market due to the tax deductibility of all expenses in one case and the non-deductibility of expenses in other cases. So naturally, that will influence your tax legislator, because if these distortions in the market are not wanted, then that will be a strong argument to eliminate them and abolish the non-deductibility. Furthermore, the impact naturally of the non-deductibility of an expense is also different depending on how high the profit margin is. Imagine alternative A is a factory and they have a small profit margin, 5%. The tax rate may be 50%. The non-deductible expense is only a small 5, as we had in our first example. Then we have revenue of 100. The total expense we have to pay is 90, or we paid is 95. The tax base, however, only acknowledges expenses of 90. So the tax is calculated based on 10, leads to a tax of 5. Your net profit is 0. The alternative B is the author of a book. The author of a book has a profit margin, let's say of 95%, because he has license fees from the revenue as a revenue, and well, the business expenses of a book writer, pen, ink, paper in former times, computer and electric current, and the cost for a software program which is probably pre-installed, you can neglect it. So nearly nothing. Now imagine this author managed to have some expense of 5, which is indeed non-deductible. Then the tax base would be 100. All his expense is non-deductible because 5 is 5 here. So the tax base is 100, the tax is 50. However, if we then make the calculation 100, actual expense 5, minus 50 tax is 45. This is still a very viable activity and profitable. So the non-deductibility will have a stronger impact on the rules applying to factories probably, and to the rules applying for book authors. If there is an organization of lobbyists in a certain state which tries to convince the legislator, please declare all expenses which we actually have as deductible, then this lobbyist group will probably not be headed by the writers, but by the representative of these factory owners. Well, this is easy. So to sum up, we can conclude all expenses will be deductible from the tax base for the computation of income tax. That gets more and more plausible. The higher the tax rate is, the lower the profit margin is, and perhaps even the more advanced the tax system and its analysis and scientific discussion are. Probably you can also conclude that to exclude a certain kind of expense from deduction will be the less possible, the higher the share of that particular expense in the total of all expenses incurred by a business in practice will be. So, yeah, this small discussion should give you a good explanation for the fact that you might find very often that only particular kinds of expenses were deductible in old times, or in the Middle Ages or 19th century, whereas nowadays nearly all countries tend to declare nearly all expenses as deductible, because the tax rates have considerably gone up and profit margins have gone down, and that triggers all that economic consequences which we have just seen and discussed just now. Now let's go to the next question, which we have on our list of potential ideas. Well, should a tax law only allow the deductibility of expense which was economically necessary, or should an expense also be made deductible if the expense was at least partially unnecessary or even a waste of money? And well, usually people say at first glance, well, um, naturally, a clever tax legislator would only allow the expense of money which is necessary to spend and not of waste. We might have a good conscience with that. So, however, in practice, very often you find different rules. And so, what happens in such cases? What does economic analysis say? Imagine our taxpayer has again €100 revenue. The expenses incurred were 95 and necessary would have been only 90. So our taxpayer spent €5 more than necessary. He made a mistake in his judgment, had a strange fit of I don't know what the reasons ever may be. He spent €5 too much, and everybody afterwards can see that. So what would be the consequence if we say the deduction is restricted to the necessary amount? Well, our taxpayer that would now have to declare only 90 as deductible expenses. At 10 would be the tax base. The tax rate of 50% leads to a tax burden of 5. The profit calculation would again be 100 minus 95, what was actually spent, minus the tax of 5. So we have an outcome of 0. So that means even if there are relatively small amounts of error in the judgment about the necessity of expense. Here our taxpayer paid only 5.55% more expenses than he really needed to do, or 5.26% of the total expense only were waste. That already leads in my system to the taxpayer's ruin. Now you can think a bit about your own behavior. Did you ever manage to pass a single day or even a week without wasting in the average, let's say 2, 3 or 5 or 10% of all your expenses? How often did you buy a bar of chocolate for 70 cents, which otherwise at a different place could have been obtained for 50 cents? How often did you pay for a coffee €3.20 in a hotel, although you knew that 2 streets away at McRubbish you could have got it for €1.80? So you will probably not be able to live at the best cost level, and to expect this from entrepreneurs would also be absolutely unrealistic. So what we see here already, a relatively everyday waste of 5% might, depending on the circumstances of certain enterprises, already lead to the breakdown of an enterprise. And wasting only 5% is a good result, probably. When people review the state expenditure behavior, they sometimes criticize state authorities for wasting 5 or 3% or so of all tax revenue. This is, compared to the average person's behavior, a relatively good outcome. And it will probably cost very much money to push the figure already more down, or even more down. So if you now insist in you can only deduct money which is not wasted, which is necessary, then you have to ask yourself something. Your taxpayer, as you see from the example, is threatened in his or her existence by these rules if he or she wastes money. So how much of hours of otherwise productive time will your taxpayer, his employees, his consultants or so, then avoid into investigations if expense could be regarded by fiscal officers as unnecessary and therefore banned from deduction. How detrimental will such a loss of working potential be to the wealth of the economy? How much will decisions be delayed by things like that? How much will that cost in the overall outcome? And if you bring that to your attention, then you already get an idea that probably it makes sense to allow the deductibility of expenses incurred by your business under all circumstances and not check the necessity. We might also draw additional conclusions. Imagine there are people who make a misjudgment about the deductibility. There's taxpayer A. He lives in a country with a tax of 50%, and their every expense, even a waste or an error, erroneous expense, is deductible. Now A indeed makes a mistake and wastes €100 without a good reason. Now, how much money does A need to earn somewhere else in order to make good for the mistake? The answer here is simple. A had €100 expense, and in order to recover €100 deductible expense, you need to earn €100 revenue from somewhere else. So the total outcome is zero. You have compensated for your mistake. Everything is fine. You wasted 100, you worked a bit more and got the 100 back. So everything's fine. You are already at zero level again, and you avoided a loss. Now let's look for taxpayer B. Taxpayer B lives in a system, again tax rate 50%, where expense is only deductible if it's economically justified. So B now makes a mistake and spends €100 without any good reason. So in that tax system, this expense is not allowed for deduction. How much money does B now need to earn elsewhere to make good for the mistake? The answer is the €100 expense are now a net loss. You can't deduct it from taxation. So you need to obtain €100 net income in order to make that net loss, to equalize it. So in order to have 100 after tax, you need, in my system, to earn 200 before tax. So that means that in this system, taxpayer B has to earn 200 somewhere else in order to make good a waste of 100 somewhere else. So in this system, any mistake of B concerning the necessity of expense is far more expensive for the firm. You could even say a tax system where expenses are controlled under the aspect if they are necessary or not punishes any mistake in the judgment of a taxpayer far more than necessary or than others. And a further consequence will be that your taxpayers will try to avoid mistakes in the judgment about the necessity of expenses under all circumstances. They will spend considerable time to avoid mistakes, and they cannot use this time to look for chances in the market or do productive work. And taxpayers who make mistakes are usually those who are willing to take risks. They will have less chances to survive in such a tax system. So those taxpayers who survive probably are those who prefer standard approaches, bureaucratic procedures, hesitating about decisions and all that. So probably you are going to inflict great harm on your economy by just designing your tax system in this way. So here we can again draw a conclusion. The higher the tax rates become in the course of time, the more likely it is that the state allows the deduction of all expenses which were caused by the business activity, even if someone spends more than necessary. You should also keep in mind that spending more than necessary is also a very, very subjective term. So if a tax law really established such a rule, then there should be and would be strong and long debates between the fiscal officers and the taxpayer about the necessity of adequacy of expenses incurred for the business. Spending more than necessary is very often a business strategy. To be generous is very often a business strategy to make good business relations. And it might be the best way to, in the long run, generate the highest profit. Now, having to debate about the necessity of all expenses which you incur with a fiscal officer would probably ruin such strategies and so bring down the overall outcome and total profit of an enterprise over lifetime. So restricting deductibility to necessary amounts is very often also very difficult and impractical in real life. So this is an additional explanation why it's not recommendable to restrict the deductibility of expenses to necessary amounts, things like that. So what we can expect after a short economic analysis is that a reasonable or rational income tax system will only exclude expenses from deduction if it's wanted to keep taxpayers away from such activities, or if the amount of such non-deductible expenses is in comparison with all the expenses not material. Okay, so again, some intermediate result. And so we have now time to go on and ask the next question on the deductibility of expenses. Now, if the rules which we can expect for the deductibility of expenses are that you can deduct nearly everything, how can then income tax legislation avoid abusive behavior? That's a question, because if every expense which is incurred by a business is claimed to be deductible, then people will come to the idea to cover their private consumer expenses as business cost expenses and try to deduct them from the tax base. So what can we do against this ingenious idea? The most popular approach of states here is that business expense is only that expense which is exclusively caused by business motives. So it need not be necessary, it need not be justified. The only thing it must be caused by business, but only caused by business. So every expense where also private consumer motives can come into play are automatically then banned from deduction. For example, German law says in paragraph 12 of the Income Tax Act, the ESTG, that all expense which has a connection to the private life of the taxpayer, his reputation, his standing in social life, and so on, is excluded from deduction as a business expense or income-related expense, if not otherwise explicitly allowed. So if an expense is incurred which partly benefits the business and partly benefits private consumer, then only that part which can be shown to be exclusively caused by business is allowed for deduction. This principle has been always understood relatively strict in Germany. For example, since or because around 1900, when the system was developed, studying also strongly increased your social reputation. There is an old tradition that the costs of the first studies or study program which a taxpayer runs through is regarded as also infected by private motivation to improve your social standing, and is therefore regarded as non-deductible, at least not accepted as income-related expense combined or connected to the revenue from your future job, because there is also seen a major private background. So in German law, you have these rules, and if it cannot be sufficiently proven which part of such mixed expense is exclusively caused by business, then the complete amount is declared as not deductible, so as private expense. which you have to finance from your net income. So to illustrate that, how that will be dealt with, imagine a business owner has a business car, and the cost of this business car amounts to 20,000 euros this year, including everything: depreciation, repairs, insurance, fuel, etc., everything. Unfortunately, the owner also used this car for some private travels, amounting to 5,000 kilometers. The total amount of kilometers driven this year was, however, 40,000. Now, is the expense now completely non-deductible? Because, well, this is a car which has been partly used for business and partly being used for private purposes. However, the answer is here that under the established rules of cost accounting, one can calculate the cost per kilometer in a convincing way, which will be accepted by every expert. So 20,000 euro costs for 40,000 kilometers. That corresponds exactly to 50 cents per kilometer in my example. So one can draw the conclusion that the cost of 35,000 business kilometers equal to an amount of 17,500 euro, and the cost of the private travels are 5,000 times 0.5, so 2,500 euro. So as in this example, the cost for private and business purposes can be clearly separated from each other, and you can clearly demonstrate which part of the total cost then is exclusively relating to the business affairs. As this is the case, you can deduct the 17,500 for the business kilometers. However, that does not always work. For example, let's look to example number 2. You are a bank clerk, and you are forced by your boss to appear in the office in a, as he calls it, decent outfit. So he says, please, suit and tie, nothing else. For this reason, you, although you are completely not a fan of suit and tie, see yourself forced to buy 3 suits, at least for a price of 400 each, because boss made it clear that your suit should also appear like a suit and not like a cheap suit. So now can you deduct, or can you now see this 1,200 euro as deductible expense because it was caused by income motives? Otherwise you might get problems on the job, so it's income related. The answer is, however, a suit can also be worn for private occasions. First, it's undoubtable here that buying the suits has a business motive. It's income related. You want to make your position in the job more safe. But a suit can also be worn for private occasions. So buying the suit is, in this case, definitively a mixed expense. Now, one could think about calculating or splitting up the costs. However, there is no generally accepted way to split up the cost of a suit to different occasions. For example, you can't split up the costs of a suit in to, let's say, the cost of a suit per minute during which it was worn, and then have a kind of a logbook for the suit, and then distribute the costs on the different occasions. This is first not practical, and second, it would also not reflect the real situation in private life, because in private life it is very often necessary, or at least usual to buy some clothes, to have them at hand when you need them for special occasions. So it might be that you buy a suit to have it at hand if you need one, and then you go fatter or you go more slim, and so actually you never wear it. However, it was a private consumer expense. And having the stuff is, under these circumstances, already an advantage. Even if you don't need it, because, let's say, black suit, nobody of your acquaintances dies during the next 2 years, and so. But you have it, and so the time during which you actually wore it does not really come into play when you measure the private consumer advantage. So the conclusion here would be there is no generally acceptable way to split up the cost of a suit into an entirely private and an entirely business-driven part. So it stays mixed expense, and so it is non-deductible cost of life completely. Just to play around a bit, let's talk about a variant. Would you, if you were the legislator, change your treatment of the previous situation if the employer does not only suggest strongly that the employee buy some suits, but threatens the employee, if you don't do it, I fire you. So the employee gets a nice written notice by the boss that you please at least buy 3 exquisite suits, because this is a bank and not a shelter for homeless persons, and if you ever show again up in this bank in the same outfit as yesterday, I am not going only to fire you, I am undertaking concrete steps to kill you on the spot. Is that understood? Okay. After this nice polite warning by your boss, you feel absolutely compelled to buy a suit. Is it under these circumstances, if you can prove them to the fiscal office, now a deductible expense? And the answer is, if you are a wise legislator, you should not give in, and you should not treat this particular situation different from the previous one. Because if you say, okay, in that really brutal situation, the business motive is so strongly, overwhelmingly in the the overwhelming dominant aspect of buying the suits, that we need to take it into account as business expense or income-related expense, then the following would happen. If you give in and say, the variant, you can deduct it, then I would, as a clever taxpayer, take refuge to the following approach. First step would be, boss, by the way, do you like me and my work? The boss says yes. Then I say, if boss, if yes, then would you please be willing to do me a favor which does cost you nothing and gives you some fun and gives some fun to me? And boss says, yes, tell me what it is. Then I say, boss, so could you please threaten me in strong words to fire me if I do not buy a certain suit, or even 3 exquisite suits, because I want to buy 3 exquisite suits. But if I buy them on my own, I can't deduct them. If you force me these brutal words to buy them, then I can deduct them as a business expense. And I presume that probably every boss would enjoy the fun and would give in because it costs him nothing. And you and he would have some fun. So that's the reason why, even if you are strongly forced to undertake this, you have now a strong business motive, but you still have, mixed with this and inseparable from it, you have a private consumer advantage. You have 3 new suits in your cupboard. And so, impossible, you can't deduct them. Good. This is how one is shielded against abuse. So we have general principles which say, okay, every expense caused by business or by the wish to generate income is in all probability deductible. The necessity doesn't play a role. And the stopper for abuse is everything which is mixed expense is not deductible. So we have a 2-step approach usually. First, you test, is there an income motive behind the expense? Second, is there a private consumer advantage combined with it? And after that test, you usually arrive at deductibility if there is no private consumer advantage. However, sometimes, apart from these general principles, certain kind of expenses are explicitly listed as non-deductible in tax laws. This, for example, happens when the expenses are regarded as non-desirable by the tax legislator. For example, German law says that bribes to other people Now, if they are caused by business, which they usually are, if you bribe somebody to get an order, that these bribes are nevertheless not deductible. This is a way to make bribes so expensive because you remember that non-deductibility often makes a transaction um, not promising anymore. Um, that these things are declared non-deductible. Or another aspect which also plays a role, very often such a business expense might come too near to private consumer expenses of others or the taxpayer himself, although in the concrete case they're being caused exclusively by business seems to be unquestionable. For example, in German tax law, gifts to business friends are non-deductible. Now, very often business friends are anything else than friends. They are business partners with whom you make transactions, contracts where you sell and buy or cooperate, and you just need to create a good atmosphere. Very often you have no idea and no wish to establish a good private relationship with these people. So it might be that giving a birthday present to a business partner can be proven to be, in the concrete case, only and absolutely business driven. However, the legislator sees, okay, usually gifts, birthday presents, and other things must be paid by the average citizen from his or her net income. And so, if business owners can present to others presents or gifts which are financed out of their gross income and so not from taxed income, that would be in a certain way unfair. It might be that the business partners begin to do some ping pong play, um, so that business partner A gives a birthday present to business partner B, let's say an exquisite Persian carpet, and on the next birthday of A, B then gives a present, let's say for 1200 euro now, some antique furniture. And so, entirely caused by business, these two guys exchange gifts which are meant for the private consumer reciprocally, and all the money is never taxed. It comes from untaxed income, and if it were accepted as a business expense. So for higher reasons of fairness, these expenses are regarded as non-deductible in these cases. Well, however, what each state regards as inappropriate enough to see it as non-deductible is usually a question of that state's individual discretion, so of what they think, where they should draw a line to private consume or things like that. And so there will be different solutions in different states, although the underlying basic idea is probably the same. I made you a list here of examples from German law. So expenses are not deductible to business friends if the presents in question are not mere trifles. So 35 euro per year is the upper limit for what could be acceptable. If you invite other persons to a business dinner, to have some meeting in a restaurant in a nice atmosphere, then 30% of the expense is non-deductible because the persons involved save the costs for a private meal. Holiday homes where you invite business friends for, let's say, a common holiday together, to have meetings and nice adventures, entirely in order to promote a good business atmosphere and to finish the week with some good business contracts. That would also be non-deductible for the firm. Fines and other financial payments for the violations of legal obligations, bribes, trade tax payments, corporation tax payments, donations to political parties, and strange peculiarity in German law, half of the remunerations paid to the members of the supervisory board of a company is also non-deductible, and some other positions in addition to that too. Well, the economic consequences of non-deductibility again are the ones which we had. things become more unattractive, and naturally they can become more expensive. For example, a business gets an order which must be delivered under all circumstances before 2 o'clock in the afternoon. Unfortunately, now the area where the customer has his business is so jammed with cars that parking is nearly impossible, at least legal one. So it is plausible that when the delivery has to be made, there will afterwards be a fine, a ticket for parking in the place where parking is forbidden, €50. Now, how much money must be earned to compensate for this expense if that fine is non-deductible, which it is? Imagine the tax rate is 50%, then €100 before tax must be earned in order to have a net income of €50 from which you can cover the €50 expense for that ticket. If the tax rate is only 40%, then only 83.33 must be earned. So you see that such non-deductible operations make non-deductible things much more expensive before tax than it seems. Well, and by the way, it is indirectly a kind of making violations of law more expensive for the rich than for the poor, which also is not completely inadequate. Okay, now let us think about the other potentially important part of the tax base, that is revenue. I hope that you probably remember our basic equation in the beginning, that income is defined as revenue minus expense, and until now we spoke about the deductibility and the aspects relating to the expense. Now we are going to concentrate on the revenue aspect. So a basic requirement will be that in income tax legislation, the term revenue must cover necessarily first all revenue in form of money, and additionally all other goods and services which have a value in money, so non-monetary remunerations or perks or benefits, however you call them. The question naturally which you bring forward now is why? Why not only cash? And the answer is simple. The basic rule must be there must be no difference if you get 20,000 in cash and then spend these 20,000 in the next second to buy a car from your employer or from somebody else, or if you directly get that car. So if the payment which you get and the give back, if that is abbreviated and you directly get that car, because there must be no difference, otherwise we all go back to barter trade and as we had behaved in the Stone Age. If only cash triggers a tax, then everybody would avoid to get cash. So that leads us to a very compelling rule that remunerations in money, not in money, but having a monetary value, must be treated as if they had been as if the market value in cash had been given to you in form of money, and then you had spent this money in a second step for the acquisition of that good or service. If you deviate from that rule, you always will have distortions of the market. For example, if that car is not valued with 20,000, although 20,000 is its market price, then taking the car directly is either more attractive for tax purposes or less attractive, and so you distort the two potential forms of trading. Either give me money or you pay me in form of the car, and that makes no sense, because economically it's absolutely identical if you get 20,000 and give it away for a car, or if you directly get a car. So taxation should not create a difference between these two things. Otherwise, as I said, it might be that you go back to barter trade, especially when the value which tax law assesses to the goods or services in question is lower than the market price. Then we would all want to be paid not in cash but in kind. What does that mean in practice? Well, Imagine we go back to that banker suit example. Um, think again, we have that strange banker's boss who insists again, my employees shall show up here in the bank wearing exquisite suits or costumes if they are ladies. And if the employees now buy these suits or costumes themselves, they are not deductible expense because a private consumer advantage is combined with them, see perk of 12. Now, what if the employees, rather clever as they are, convince their boss, please don't force us to buy the suits. Buy the suits, please yourself, hand them out to us, and that avoids the problem. And the answer is, well, it will not, because the tax treatment, if the boss himself buys the suits and costumes and gives them to the employees for free, would be you would first have to do as if the boss had given the market value of these suits and costumes in cash to the employees. So if 1,000 per person is spent on the costumes and suits, then we have to do as if the employees got a taxable cash payment of 1,000. Then in the next step, we have to assume that the employees spent their 1,000 in cash on the acquisition of suit. And this would be, as we already showed, not a deductible expense because this 1,000 is mixed private expense. It touches the private consumer sphere, so it cannot be deductible. So we would end up with a cash revenue of 1,000, which is fictitious and has to be taxed by the employees. A second example, imagine there is a fashion model, let's call her or him FM, and gets an expensive dress, which she is evidently she, has to wear during a fashion show. The market value is 3,000 euro. For her work, she gets a wage of 200 euro or so. I don't know what's customary in that sector of economy. But now what would happen if her bosses allowed her to keep the dress after the show for herself? Usually, instead, they will insist in getting the dress back and then sell it secondhand on eBay or somewhere else for a laughable price. But she is not allowed to keep the dress, which sounds relatively harsh and mean and could enrage us until we explode. What an unfairness. However, if we analyze the situation a bit closer, then we see if the fashion model is allowed to keep the dress, then she has to be treated as if she got the market value of the dress in cash, so as if she got additional 3,000 euro as income, as revenue, and as if then she had spent these 3,000 euro a second later to buy this dress from her employer. Now the acquisition of such a dress is unfortunately always combined with a private consumer advantage, because that's clear afterwards she only can need it for private purposes. So you always have a mixed expense and there is no possibilities to split it up. So the 3,000 euro are completely non-deductible. So if the bosses want her to keep the dress, her taxable revenue would go up to 3,200. She has, however, only 200 in cash. That's far less than she needs to pay the taxes on 3,200. So the whole business model would no longer work. So conclusion, it is perhaps a kind of an outrage that she has to give back the dresses and can't keep them. But it is rather a good idea of her bosses not to allow her to keep the clothes, because otherwise she would be ruined and nobody can want that. Or one would have to increase her salary for the day enormously so that she were able to cover the tax costs for first the cash payments and the non-monetary remunerations, and that would render the whole thing too expensive. A similar problem has in the meantime shown up in the influencer sector. Imagine X as an influencer who publishes videos and photos on the internet showing her or him with dresses, shoes, accessoires, which she receives from fashion firms with a request to show them during the videos, thereby to impress the viewers. to let them dream of how nice would it be if I also had such a thing, and so on. So to do some clever marketing activities, she then gets a small payment from everybody for whom she does this, 100 or 200 euro, I don't know, have no idea. And then, surprise, she can keep all the nice goods in question, or he, whatever it is, I don't know the details. But tax consequences would be considerable because, and are considerable. The revenue for income tax purposes is again the market value of the goods received plus the cash. So if all the nice goods which you received and used during these videos later stay in your possession, then you did not only receive the cash, 100 and 200 euro, but also you received revenue with the value of, let's say, 1,000, 2,000, or 3,000, or perhaps only 200 additional euros, depending on the goods which you got. And so you will have to treat that as taxable revenue. And so probably you will need your cash to cover the tax burden on these enormous revenues. And so that sometimes raises the question, from which things will you be able to live? Very often influencers are reported to have financial problems because the fiscal administration, at least in some regions of Germany, has detected the problem and has now received orders to inspect these situations more closely if these people correctly knew and declared their non-monetary revenues from their activities. And that can cause considerable financial problems for them. So, yeah, now a last remark. This rule that payments in kind have to be treated according to a two-steps approach, namely that you do as if the taxpayer got the market value of the good or services in form of cash and then spend that cash to immediately afterwards acquire these goods or services. This rule will sometimes have some modifications for reasons of simplification, but only for reasons of simplification if you have a clever tax legislator. For example, if an employer gives a free meal to the employee every day, this is definitively a financial advantage. However, it's definitively also very difficult to determine the exact market value of what every different employee has eaten and which day. So a standardized approach seems to be justified to say every time when somebody consumes a free meal paid for by the employer, then the market value of such a meal is deemed to be always the same market value called X, let's say €3.50 or so. That simplifies life. Otherwise, you would have to place an accountant into the Mensa of a firm who then always takes notes who eats what and for which price and how high the subsidy borne by the or contributed by the employer has been in the concrete case. That's impractical. A second frequent example, the permission to use a business car also for private purposes is definitively an advantage which has a monetary value for an employee, because then the employee saves own costs for the acquisition of an own car, or if he already or she already has a car, then saves costs for the acquisition of a second private car. So you could determine the advantage from this permission as the cost per kilometer of private travels, but such a computation might become extremely difficult in the individual case, at least to check if it's correct. So to avoid endless debates, you might set up a standardized way to estimate the market value of such an advantage, just to make life easier for all persons involved. So to have a kind of a compromise. Sometimes the legislator might even say, I declare certain non-monetary revenues as tax-free for reasons of simplification. For example, in Germany, if An employee gets a business telephone from his employer and can also use this to receive private telephone calls and make private telephone calls. This is explicitly stated to be tax-free. Why? Well, if it were different, then you would have to take the total cost of the telephone and the telephone calls. Now, this is very often a flat rate per month. Then you would have to find out how much the cost per minute of a private and a business telephone call had been, how many minutes were spent on private telephone calls and how many on business calls, to check through all the list of the telephone numbers which were called and which did call. The last information is nowhere available if you probably don't work for the NSA or another secret agency. So to track and prove all this thoroughly would probably end up in a bureaucratic chaos, and the whole amount of tax base where you are having disputes about is probably €12.50 per month or even less. So that's a complete waste of working time of all people involved, and so that justified why this was declared tax-free. And now sometimes when you have lunch break or so, you can use your employer's computer during the lunch break for private purposes. For example, to inform yourself about the football results, to check the new special offers of your favorite supermarket and things like that. Now that has been declared tax-free. And here again the question is why? Because having the possibility to use the internet during lunch break definitively saves you the cost of an own private computer in your office, of a surf stick and internet connection, or however what else you take in your office. Now let's debate how high would be the market value of such an internet connection and the rent or so for a computer which you can use for 30 minutes or 20 minutes or so in your office, but not every day. You would have endless disputes about that, could indulge in market research studies, and in the end, also here, the total outcome of additional tax would be completely disproportional in relation to the input of work on all sides involved. So naturally, you call that tax-free. Recently, another tax exemption was created. For example, you know from a previous example that the private usage of a car can consist of considerable non-monetary advantage with a high market value for an employee and is therefore taxable. Now, some years ago, some people began to think about bicycles. There are firms where the employees use bicycles to ride through the firm's area and to do some business short travels where a bicycle is more effective than using a car. Okay, now naturally, come what must come, the one or other employee will take the bicycle and use it for a private ride, let's say to the next supermarket or so, outside working hours. Nobody really checks this. So very often people having a business bicycle at their hands can also use it for private purposes. And when now somebody brought that into discussion, then everybody else was probably shocked and puzzled. Oh my God, how can we find out the market value of the possibility and the permission to use a business bicycle for private rides? So could you demand that people using a business bicycle have a logbook and write down the kilometers driven? With a car you can demand that because there are technical devices where you can see at which kilometer you started and at which kilometer you ended. How do you do that with a business bicycle? They don't have kilometer devices which count the kilometers ridden or so. How can you make an exact cost calculation? What are the costs, by the way, of a bicycle? There is no fuel. There's only the cost of acquisition and the repair cost, and I don't know what. So here you can also drive yourself into madness. So it cannot surprise us that also for the private usage of a business bicycle, has recently been created a tax exemption under 3, number 37 German income tax law. Things like that are also expectable in foreign tax legislation. Not always the same occasions, naturally, but where you say, okay, being exact here with calculation of the revenue, that's just a waste of time, and the costs created by being exact here outweigh by far the tax revenue which can be obtained by being exact. However, we must clearly see that wherever you have such a deviation from our basic rule, please, every payment in kind has to be seen as if the market value had been given to you in cash, and then you spend the cash to acquire this good. That will have the consequence that there will be a distortion of the market. For example, if an employee goes to a restaurant and buys a meal for €8, he has first to earn €8 net income before he can afford to do this. Now, if the employee has a tax rate of 40%, that means he needs to earn €13 approximately gross income to pay for this meal. Now, if the employer organizes a free meal for this employee, the same meal is only valued as a revenue of €3.50. Let's assume this is the current standardized market value in a certain legislation. In that case, he only has to pay taxes of 40% on €3.50, so €1.40. To earn these €1.40 elsewhere, he only needs to earn €2.33. And that means that the meal is affordable for him already for a gross income of €3.50. That is what his employer has to know. That is what he gets here. And €5.83 or so. Now, the employee might ask his boss, what about a deal? You reduce my wage per day from €100, let's say, to 90 or €95, and instead you give me a free meal each day, let's say to 90. In that case, the wage cost of the boss changed from 100 to 90 in cash, and 8 for the meal, because the meal has also to be bought by the boss for €8. For the boss, that's saving €2 in comparison to the 100. And the disposable income of the employee changes from 60% of 100, 60, minus the cost for the meal, €8 to 52, to 60% of 90, that's 45, minus €1.50 to 52.60, because now he doesn't need to pay for the meal anymore. So 60 cents more. So that would be a good deal for both of them. We could even think about distribution of the advantage, which is perhaps a bit more favorable to the employee. Let's say the boss reduces the cash payment to 91 or 91.50 or so, but in principle, using that free meal option, that the boss orders the meal and hands it over for free to the employee, would be an advantageous construction for both of them under the tax aspect, and so they would try to organize it this way wherever it makes financially sense. So simplifications in form of standardized market values for certain goods or tax exemptions, even for them, will only be made if the efforts saved by the simplification outweigh the loss of tax and also justify the distortions in the market. Or if such effects, let's say a distortion in the market or an incentive to give free meals to employees or so, are even wanted by the legislator. So if legislator wants that all employees get a good meal, or that the legislator wants to cause employers to pay for the kindergarten visits of their employees' children and things like that, then this makes sense. Okay, these were my remarks on the revenue aspect, and so we talked today on the tax base and the tax rate aspects of the income tax, and it was a long video, and I hope you survived it well. So thank you very much for listening. This time it was a very long adventure this time, and I hope you survived it. If you liked it, please like it and recommend the channel to 5 other guys or girls who probably like it too. And the standard wish, if you didn't like it, please recommend the channel to 5 people whom you don't like. So that would also bring you some fun and me some new subscribers. Thank you very much for listening, and hope to see you back sometime soon on the channel.